Hello everyone and welcome to episode 12 of the New Trader's Playbook. Today we're going to be talking all about the differences between your high time frame and low time frame charts and how understanding this can really help you, especially if you're a beginner, to start making progress in your trading career. So if you've ever found yourself in a long, heading up on a 1 minute chart, you're expecting price to reverse, but the daily chart is actually in a massive downtrend, this episode is definitely for you. So let's start off with something that is important to remember. The high time frame chart is your map. Right? I want you to think about it like that. Map tells you where to go. Right? The low time frame chart is actually more like your looking glass or your magnifying glass. It allows you to dig a little deeper after you already know where you're headed. All right. So let's talk about what we mean differing between high and lower time frames. So standard higher time frames, what you beginners are going to see is going to be the daily chart, the 4-hour chart, or maybe the 1-hour chart. They're slower. It's a little bit less noise. They usually show the main major trends and also offer some big levels, right? So we want to know what are our high time frame charts so that we can stick to those, knowing what is more likely to stick because it is on a higher time frame. Now, granted, if you are trading, maybe investing, you might also be looking at a weekly chart or a monthly chart. But for the type of trading we're talking about, usually on this channel, we're going to stick to our high time frames as our daily 4-hour and 1-hour. Now, your lower time frames are going to be just shifted down a little bit. Your 15, your 5, and your 1 minute charts. Obviously, these are going to move a lot faster. There's going to be a lot more details, right? A lot more fake signals, and unfortunately, some emotional pressure the lower you get down into the time frames. Yes, there are lower time frames than this. As a beginner, highly would not suggest anyone going lower than a 1 minute chart. I have spent time on a 15-second chart. Wasn't a good idea, but I did it. When it comes to the high time frame, as we mentioned before, it's like a map, but it can also be kind of like a story, right? You've seen a story, it was written, that's your high time frame. That's what the entirety of what's happening, what you get out of the market's movements. But when you look at the lower time frame, it's kind of like the sentences. It's what makes up the story. But if you just read one sentence, you really won't know what the entire story is about. And that's how we really should focus on the difference between how and when to use high time frame versus low time frame. It's also kind of this idea of chaos versus calm. Sometimes the 1 minute can be really chaotic. Lots of wiggles, lots of quick movements, lots of shifting that can honestly trick you and confuse you. A lot of things can happen inside of a higher time frame candle, which from that perspective, the higher time frame perspective, can actually seem pretty calm and simple. Let's jump right into TradingView and take a quick look at what I mean by what's inside of the lower time frame could show a very different message than what's in the higher time frame. Here is a nice example of something that happened this past week in NASDAQ. So if you look at this, I've created kind of a box around this amount of price. And you can see, obviously, price did a lot of stuff here, right? Up and down and up and down and up and down. Maybe some of you that are familiar with trend trading, you may think, oh, okay, well, I see a lot of things that I personally like in my style of trend trading. Very nice. I love that. But one of the things you have to be really careful with is what this means on a higher time frame. So a lot of action here on the 1 minute. But what if we were to shift up simply to the 15 minute? What might that have looked like? Well, as you can see here on the 15 minute, lots of chaos, really. The range is a lot less easy to see. Yes, we can see the highs and the lows, and they're still there, of course. But what we're getting to see is as we move a little bit higher, the stronger highs and the stronger lows are kind of starting to appear as opposed to what we saw in the lower time frame. How about we shift up to the 1 hour? What would that look like? Well, obviously, going from a 1 minute to a 1 hour is going to be a huge difference. Now we've got fewer candles, and we might be able to see inside of what's happening. If you pay attention to my channel a lot, you know I love the middles of the wicks. You're seeing a really nice reversal here in the middle of this wick, and a really nice reversal in the middle of this wick. The higher you go, the easier it is for you to see the movement, the story, the map that is leading you in the direction of where you want to trade. And if we shift up to our last one that we talked about, you'll notice even here, 4-hour candle, all we have is these couple of things. And all of that we saw earlier on the 1 minute is encompassed inside of this small area of 4-hour candles. Just knowing that this one single candle was a lot of that movement can help you to stay on the right side of price by seeing, okay, well, what happened on the higher time frame that will allow me to dig deeper into the lower time frame to take really quality trades. So we talk a lot here, obviously, because this is the New Trader's Playbook to beginners. And as a beginner, you're really going to want to start your journey off with the high time frame. Yes, you can jump right into the 1 minute charts, but you are going to find it much easier of a journey towards trading success if you start off with a high time frame. Now, why? Because we know that the high time frame charts really do a good job of filtering out noise, and they really do help you to reduce the amount of impulsive decisions you're going to take. Honestly, it is so easy as a beginner to chase every single move that comes up. And there are so many moves that appear, so many setups that appear, the more candles that you're looking at, right? So the lower the time frame, the more candles appear, the more opportunities for you to quote unquote see something in price. Now, second, we have it says that high time frame gives you a clearer trend direction, right? More obvious, major support and resistance levels. Really, you begin to see the big picture, and that is extremely important. Do we want to be successful traders? Yes. Do we want to make money in the market? Yes. You have to be able to see the big picture in order to then trade in the direction of the big picture. If we were to just take the lower time frame by itself, really all you're left with is a lot of signals, a lot of fake outs, more stress than you'd really like to have. And honestly, it's a really good way to overtrade. You'll see things that pop up and you'll want a little piece of them. But honestly, at the end of the day, most of those things are not going to be worth the squeeze, right? Not worth the juice that comes out. So we really want to be careful on overly focusing on the low time frame for deciding on directional bias. Remember, the high time frame is your compass. The low time frame is simply the zoom that's going to help you to kind of dig in and see where do I want to trade, how do I want to trade, and what's the right location for my trades. So what we have here is we can create a simple 2-frame flow that can honestly work wonders when it comes to how you're going to trade effectively in the market. So let's look at our steps. Step number 1 would be to look at the high time frame. This is how we are going to help pick direction and also some super important levels. So we're going to want to look at those higher highs, higher lows, or lower lows, lower highs. That's going to give us some directional bias. What that means, which we saw in one of the earlier episodes in this series, is that if you are getting higher highs or you are getting higher lows, price is directionally biased towards the upside. Lower lows with lower highs, directionally biased to the downside. Or kind of like in our picture we saw earlier from TradingView, we may end up finding ourselves in a range. If we're on a high time range, really, really great place to be able to take some solid trades. Then we want to look for some key levels. Mark out those key levels, something like prior highs or lows, some support and resistance levels, maybe even some trends or trend lines. This is how we're going to start off from the high time frame and then move our way down. Now, step number 2, focusing on the lower time frame, we're going to find our entries that are in the direction of the trend that we found from the higher time frame. So we're going to do our longs when we're in an uptrend, and we're going to do them when they pull back into a support level, or opposite, shorts when they pull up into a support level. Our lower time frame, that gives us timed entries dictated by pullbacks, maybe some kind of confirmation, or maybe a break and retest. It really depends on what kind of strategy you eventually decide that you love the most. That's how you're going to decide how to proceed on the lower time frames, but the higher time frame is where you're going to get the most important locations for picking directional bias. Step number 3 is combining everything all together. So we're going to be looking at high time frame for direction, low time frame for exact locations for entries. Now, I want to show you a little something back on TradingView that I hope will help to make this a little bit clearer. So let's take a look at a different product here over on gold. And I want you to take a look at some things. I'll just show you a few that are personal favorites of mine. I love when gaps are filled. And one of the things that I love about gap fills is that when price gets to an area, once it reaches that area, not before, but once it reaches that area, then we can go from a high time frame, which we're on a daily chart right now, and then shift down into the lower time frame, and that's where we will take our trades. So let's say, for example, you see that there are 2 main gap fills that happened this past couple of weeks. You'll notice with me, there's the gap, price fills the gap. There's the gap, price fills the gap. Yes, this is hindsight. But one of the things that is important about hindsight is you do it enough, it becomes foresight. So let's take this as our high time frame and say that these are areas of interest. Right? So when price gets there, I am interested to see how price reacts on a lower time frame, on my chosen lower time frame. So let's say we'll go down to the 5-minute. So here are our locations for price to go and fill those 1-day gaps. Now, I'm looking at the first one. So price comes down and it fills this gap. Now, for me, this candle is not necessarily one I would just enter on. So could I get into the trade later on? Okay, well, there's a few different things. If you've taken the opportunity to look at some ways of trading, you'll notice that gaps can also reject price. So as I've talked about before, if you notice, I'll put this this halfway middle line on there. Remember, we talked about the closes of the candles dictate oftentimes the strength of the move, right? You notice how these candles close above that middle level? Love that a lot. Price comes down, dips in there. Now, if you are familiar with break-in structure, which you would see something like this, changing your market structure almost, price goes up. We have an idea that maybe price might continue, but we want to get a good entry. So where do we get our good entry at? Well, if you notice underneath here, we have either an inversion, which means essentially two gaps right over the top of each other, or we simply have this gap right here. Once again, check out how beautifully all of these have closed above the middle level of this gap, right? There are many ways you can enter trades. There are many ways to enter trades, but you'll have to find something that you find comfortable for yourself, that you can not only look for the right place to enter, but also more importantly, where am I going to put my stop loss? Where am I going to put my take profit? Either way, I love both of these. Now, why do we like these so much? Because what happened down here? We filled in our gap on a daily time frame. That's the most important part. The daily was filled, right? Once that happens, then we can look at whatever continuation type entry you like. You can find that within the following price after it hits our place of interest. Now, with that being said, let's go to the other one, because we saw that price was going to go up here and snag this one. All right. Is there anywhere where we could have taken an entry? Well, me personally, I'm always going to look at these gaps, as I've mentioned before in a few episodes. And once again, what do we see? There's a gap. After we break to the fill, right, the fill of this daily higher time frame imbalance, we come down, we leave a gap, we fill the gap. Me personally, I would have loved to have taken a trade right here, somewhere around the halfway point of this wick, or even possibly at the fill of the gap. Those are just ways that I enjoy taking trades. But you'll find what works best for you. The most important part is we only use 2 time frames, right? We use a high time frame to guide us in the right direction and a low time frame to tell us where exactly to trade so that we can have great risk to reward. All right, so when it comes to looking at high and low time frames, there are some definite common mistakes that happen, unfortunately. Sometimes new traders love to trade against the high time frame direction because they see something on the 1 minute chart. You gotta really think about that, guys. It's kind of silly, to be honest. There's the 1 minute, and it's really there to just fool you into thinking that you see something and to then get you hooked, okay? Be very careful with choosing locations for reversals on the 1 minute when you are staring at the higher time frame, screaming at you that it's going the other direction. Second one, new traders like to switch time frames in the middles of their trades just to make them look better, right? Yeah, your thesis was built on certain time frames. If you switch the time frames just so you can feel better, the thesis may appear differently, which then might cause you to want to adjust your time, your stop loss, move it a little bit lower, right? We've talked about this before. If your stop loss is wrong, your entry was probably wrong too. So stick to the theory, the thesis you had on your original time frames, and stick with that for the entirety of the trade. Next one, using too many time frames can easily cause analysis paralysis. If you're not familiar with that term, it just means there's too much to think about and now you're freaking out. Sometimes, and in many cases, less is more, right? Too many charts can often really cause a lot of confusion. Take a look at this. That's a lot of charts. There's a lot going on there, right? Now, granted, this may be a professional trader and he may be looking at a lot of different products. But if you find yourself looking at the same product 5, 7, 8 different time frames, it may end up being overwhelming to your brain, and you might unfortunately end up missing the great trades because you're too focused on the perfect ones. So what are some rules we can stick to? Rule number 1, we can pick 1 higher time frame chart and 1 lower time frame chart and stick to those. And we can also refuse to change the time frames after we're in the trade. Assess the trade based on those time frames that you traded it on. Me personally, I'm a big fan of using the 1 hour and the 5 minute. Those are my favorite 2 to stick to. Now, what do? You're a beginner. What should you use? What should you stick to? Well, if you want to be a little bit slower, a little bit calmer in your learning experience, maybe something more of a swing trading or deciding on decisions later on in the day, you may want to stick to both of the time frames being kind of high. So maybe your high time frame is the daily and your low time frame is the 4 hour or the 1 hour. This is going to be a lot slower, a lot fewer trades, but it is a really good place to learn how to then get into something a little faster later on. There are many traders who make lots and lots and lots of money only using the daily and the 4 hour. Okay? Now, if you want to do a little bit more intraday day trading as a beginner, you may want to start off with the 4 hour and the 1 hour as your high time frame, and then leave the low time frame to their 15-minute and the 5-minute. I do think it's a great idea for beginners to stay away from the 1 minute, as it is a place that can eat beginners alive. But at the end of the day, what we're looking for is our top-down analysis, which really just means that we are starting at the top, right? We start in our higher time frame charts, we're marking up our map, right? And then we're going to go to the lower time frame so that we can find the right entries. As a beginner, 2 time frames is enough. You do not need more than that. Okay, so we're gonna have some homework. So this week, I want you to pick 1 higher time frame and 1 lower time frame and write them down at the top of your journal, because yes, we use journals, beginners or experienced traders. Your high time frame is going to be your map that leads you in the right directions. Your lower time frame is going to be your location for entries, right? We're back to that magnifying glass. No other charts will be allowed for 20 trades. Yes, I know it's going to be difficult if you're one that likes to move around, but this is homework. And the idea is that once you complete those 20 trades, I want you to analyze your success, analyze your emotions, the things that you felt, the things that you saw, and see how it went. How did you trade? How did it feel using fewer charts to move around and not having to jump left and right to the 1 minute, the 2, the 5, the 15, the 30, the 60, all that other stuff? What did it feel like to just erase all the extraness, focus in on 2 charts, and use your higher time frame as your map, your lower time frame for finding entries? Use this homework as an opportunity to analyze what it might look like to change some things up in your trading and to decrease the amount of excess that you might be dealing with now when it comes to finding the best trades from a lower and higher time frame perspective. So thank you so much for listening to today's episode. If you enjoyed it, please feel free to like and subscribe, and I'll see you in the next episode.